All righty. Let's go ahead and get started here, everyone. 1 second.
Recording in progress.
All right. Welcome, everyone, to the first Sunday macro wrap up of 2026. Hope everyone had a fantastic new year and was safe out there. We have a pretty decent week coming up this week, a pretty eventful, packed week for the first week of 2026 as far as the macroeconomic data goes. Lots of catalysts, and this will really be the first week in a long time since we've had like a full volume week, right? Because of the holidays, the trading volume has been very low, and so you've had a little bit of I guess you could say like a false trading volume week for the past couple weeks. And so with trading volume coming back in full force, this will give us a lot better and clear direction on which way the market is going to interpret a lot of the different indicators that we've been seeing over the past couple weeks. And so we did get new all-time highs on or the day after Christmas on December 26th. So you can't ignore that. And, going into this year, we've kept the green background for the S&P 500, right? So if you guys notice in the background, the lights are green, which means the S&P 500 is in bullish trend. That has been maintained. And so, we'll see what happens during the next couple weeks here in the opening for 2026, but it looks like that will remain intact. We have had a little bit of a rotation, though, from a full investment into the large Mag 7 stocks into more of a concentration into the low or the higher volatility smaller cap stocks, which have been doing a lot better. And that's considered a broadening effect of the market, which is good news. But what's interesting is that we continue to get better than expected signals from the yield curve. And the yield curve is something that my team and I like to use because the bond market is considered smart money. And when the smart money is signaling something, you better pay attention. And so the bond market, along with the currency market, equity market, precious metals, cryptocurrencies, as well as the hard economic data that we get released every single week by the government or private data, all of those come together to tell the real story, right? What the data is actually suggesting. Because what you have to realize is that, when you turn on the TV, when you look at the headlines on CNBC or X or any of these other mainstream media outlets, what they're trying to do is invoke an emotion in you. And because they're trying to sell you something, right? Sell you on an idea, sell you on like fear of missing out or fear of, staying in the market. And so you got to pull out, right? They all are trying to invoke some type of emotion out of you. And in order to fade that noise, you have to pay attention to the macro signals that we're going to be covering here. And so, yeah, welcome to the Sunday Macro Wrap Up. For those who are joining for the first time, the way that these work is that for the first 30 minutes of the hour, we stream it live on our social media platforms, and then for the second 30 minutes, we go offline and we just have a discussion Q&A, as well as we review actionable ideas for those that are part of our macro investing community, as well as our partnership circle members. And so, if you'd like to join that, or at least check out and learn more about that, you can go to our website, macro-optics.com, and you can just view the membership options, and you can take a look at the two core services there. But getting into this week here, if we go on our website to the market dashboard and go to the economic calendar, you can see. Let me go ahead and blow this up a little bit. As you can see, we have a pretty busy week this week. Now, first, you can see that tomorrow we get the ISM manufacturing PMI, which is probably the most important leading manufacturing indicator that we have. And so that's a big one. It's been in contraction for quite some time. Let me actually see. I didn't bring it up, but let me see if I can bring it up here live while I'm talking to you all. ISM manufacturing. This was the false signal that a lot of people in 2023 thought was going to cause a recession. In 2023, that actually didn't. And so just to be able to read this, anything above 50 is in expansionary territory, and anything below 50 is contraction. And as you can pretty much see, since 2022, late 2022, the manufacturing sector has been in contraction, or it's been in a recession. And typically, manufacturing leads the aggregate economy because one feeds into the other, and it's an early signal. But what's interesting is that with this manufacturing recession that's going on, that hasn't necessarily translated into the aggregate economy or into the services economy, which is what we as Americans really care about, because we are a service-based economy. And so we still need to pay attention to it, because it does matter. Because if you do have a very sharp correction in manufacturing, then as well as a sustained period in contraction, that's still not good. But that's not, you can't just stop there. You have to also look at what's going on in the services PMI, which we also get this week. I believe that's on Wednesday at 10 a.m. Eastern time. And when you take a look at the services PMI, that's actually in expansionary territory and has rebounded over the past couple months. So that is incredibly important. And if we go back in time, as you can see, this has slowed down from 2022, but it has not gone into contractionary territory for a sustained period of time like we see manufacturing, right? So you actually see that only below 50, maybe a couple months, right? We saw that back in June of 2024, very briefly, in May of 2025, and April of 2024, and December of 2022. So really, over the past few years, pretty much since the pandemic, we've only seen it below in contractionary territory for 4 months, or 4 single months, and then it's rebounded out of there. And so this is part of the reason why we haven't seen an aggregate recession in the economy. Now, a part of that, a lot, is because, unfortunately, this is the reality of things, is that there's a very small percentage of American consumers in the top 20% or higher that contribute to over 50% of all consumption, right? So rich people continue to spend, and that is showing the majority of why there hasn't been an aggregate recession. And so even though the majority of the country is still in their own right feeling a recession, the top 20 to top 10% of earners and asset holders in the United States are keeping it from having what's looking like a paper recession, right? A recession on paper. So, and that is what's describing this K-shaped economy that we've been continuing to have going into this year. The K-shape, meaning that the top end of the K are the wealthiest Americans, and the lower half are the most poor. And yeah, that's pretty much what we've seen. Now, as interest rates are starting to come down, what's interesting is that we are getting a little bit of mixed signals now. And what's interesting, and for the first time, and one of the reasons why the market got it all wrong for the recession call in 2023 is that the raise of interest rates, although it did cause a huge correction in 2022, and it ended up being a stimulus for a lot of companies that have a lot of cash on their balance sheets, right? Namely the Mag 7 stocks. Rates went up, and those things continue to make new all-time highs. And then, the people who control the S&P 500 weights recognized this and started to be more overweight these Mag 7 stocks, which is the reason why the market has been continuously performing well, even though it seems like the economy is getting worse, right? So, in this more financialized economy, you can't really take a look at the financial markets to determine what the aggregate is feeling. But for this channel's sake, all we are trying to do is manage our capital so that we are outpacing inflation, which at the timing of this recording, it did come down from the previous CPI release a couple weeks ago, which was a little bit controversial, only because it didn't provide all the data. In any sense, though, when taking a look at the Cleveland Fed inflation nowcast, we can see that it is showing a large decline in CPI and inflation between now and January, which gets reported in February. And we've been talking about this deceleration in inflation on this channel for the past couple months as we haven't gotten the CPI numbers due to the government shutdown. And so you can go back, in November and early December, you can see we've been talking about this disinflationary type of environment. And it's not because we have any type of special tools. It's that we look at the yield curve. And so the title of this Sunday macro wrap up is called "Don't Ignore the Bull Steepening Yield Curve." Because if we take a look at this thing, we can see that the yield curve is making new highs, right? And it continues to go up, or it's called a steepener. Okay. Now you have to remember that the yield curve is the difference or the spread between the 10-year US government bond yield and the 2-year US government bond yield. So it's the subtraction or the difference of those two yields, the 10-year minus the 2-year. And so what you also have to remember is that the short end of the curve, or the 2-year, typically represents the bond market trying to price in future rate cut or rate expectations, right? Whether the Fed is going to lower or raise interest rates. Where the long end of the curve, that's more free market controlled, right? The Fed doesn't really have too much influence the farther you go out on duration on the yield curve. And that typically represents the bond market trying to price in future growth and inflation expectations. And so when you take the difference of those two, that's also what you're representing. And that's why we can get these forward-looking bond indicators that will tell us what the bond market is signaling in terms of rate policy, as well as growth and inflation. And so that's why we've created this indicator here that I have on TradingView. This is my team's yield curve phase signal. And as you can see, there's some color codes behind this. And we've created an entire worksheet that goes over all these color codes and what they mean, blah, blah, blah. But the main thing is that we are into what's called a phase trend shift number 10, which is where we went from a bull flattening phase to a bear steepening. We've seen this in early 1983 or late 2003 to 04, also late in 2020 and into 2021, where growth and inflation surprises after a subdued period led to long end bond sell-offs, right? Which is what we're seeing right now. The curve steepens as the 10-year jumps on reflation. But in our case, we're actually seeing disinflation. And so the market is more so showing that growth is remaining sticky. Okay, because remember, the long end of the curve can go up if it's expecting inflation to rise or accelerate, or growth to accelerate, or both at the same time. But in this case, we continue to see how GDP forecast and everything is having growth reaccelerate, and we're seeing this in the private data. And so this is more so providing support to the soft landing narrative, which is why we may have seen new all-time highs in the stock market the day after Christmas time. And so the only problem is that a lot of this GDP growth that we're seeing is mainly being done by the wartime fiscal deficits that are occurring right now. What do I mean by that? What I mean is that when we take a look at the fiscal deficits, so this is an interesting website, bipartisanpolicy.org. They have a deficit tracker. And the fiscal year of 2026, which started in October of 2025, that is technically the first fiscal year of Trump's term, right? So now this is fully Trump's spending. You have to remember that the fiscal years kind of overlap with the elections. And so even though Trump was elected over a year ago now, the previous or the newly elected administration inherits a full fiscal year of the previous exiting administration's term. Okay. And so, as you can see from the 2025 year, this was still a very large acceleration in fiscal spending. Not as much as 2024, but pretty stark, right? 2024 was 1.83 trillion, and that's the deficit, right? Which is the difference between how much we take in with tax revenue versus how much we have to borrow in order to make up the difference for the spending obligations. And so in 2025, it was 1.775, which is pretty close, right? 2024 and 2025 are pretty much the same. 2023 was 1.69 trillion. So the trend is still just incredible, incredible amounts of spending going on, right? And what you have to specifically pay attention to is the percentage of deficit to GDP, which I don't have a chart of that right now. Maybe we can look it up as we talk. Let's see, deficit to GDP percentage. Yeah, so as of right now, it's at 6%, and that is not great. Really, the only time when you see a 6% budget deficit to GDP of 6%, that's typically during wartime or when there's a national emergency. Historically, you've seen the deficit range between 2 or 3%. So it being 6% is nearly double of what we usually spend, and we're not even in like a hot war or anything like that. And so, it begs the question, why are we doing this? Well, the reason why is because interest rates still remain higher than what the administration wants or what the government wants. And, before you say, oh, you're a Trump hater, blah, 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 Biden did the exact same thing. In fact, if we're only looking at fiscal policy, meaning what the government is spending, so just spending policy, not any of the social stuff. If we just look at spending policy, the Biden administration and the Trump administration are virtually the same. And I can prove it to you. When looking at the Treasury security issuance, you can see here how back in May of 2023, when Janet Yellen was the Treasury Secretary, that is when you saw a large spike in Treasury bill issuance, which is, short duration bonds being printed. And so when Trump was coming on board, his elected or appointed Treasury Secretary, Scott Bessent, he was critical of what Janet Yellen was doing. And he was saying that he was going to no longer do this because it's an unsustainable practice. Well, he got in charge and it went right back to, as of October 2025, it was at the same all-time highs as it was in October of 2024. So there was a little bit of a dip, but then from June to the end of the year, it had a huge ramp up back to all-time highs. So there virtually was zero difference between Scott Bessent and Janet Yellen, right? And the reason why, surprise, surprise, right? Politicians lie to us. Well, the reason why they're doing that is because the debt problem is so bad that they cannot extend duration out because interest rates are still a lot higher than they were in the past, over the past 15 years from 2008 to 2020, which was 0%. And now, it's still a lot higher, right? 3.5% is still a lot higher than zero. And so when taking a look at the target rate probabilities for the January 28th meeting, the first Fed meeting of 2026, we can see that at the timing of this video, there's an 82.8% chance that they're going to remain paused between 3.5% and 3.75% for the Fed funds rate. And, when taking a look at what it's currently pricing in for the rest of the year, what's interesting is that it's actually showing a rate hike. Or I'm sorry, not a rate hike. Two rate cuts, one in March of this year, and then another one in September, and then they have it paused pretty much for the next year and a half until, it doesn't show further than December of 2027, right? So there's only two rate cuts being priced in for this year, and it might even go higher than that, meaning we could possibly see zero rate cuts for this year. But the whole point of that is saying that unless a huge recession happens, the Trump administration is not going to get their 1% Fed funds rate. And the bond market, this steepener right here, which could be bullish for things like Bitcoin, things like stocks, AI stocks, and all those things, which I hope people are, starting to get familiar with investing, because that's the only way to protect your capital against inflation and this crazy government spending that's going on. But this yield curve steepener is telling us that the bond market is starting to revolt a little bit, right? During the last Fed meeting in December, they told us that they are going to try and maintain ample liquidity reserves because they've ran out of money from the reverse repo facility. And that actually is not great news for the liquidity metrics, because that means that there is a lack of liquidity in the system from what we previously had. And they essentially admitted that liquidity is getting tighter, and so they're having to step in, but it's not full-blown QE like you think about when you have a full-blown panic. And so a lot of people were saying that online, but it's not really that way. And so the big caution heading into 2026 is this liquidity dynamic, and if the bond market starts to revolt against the government as well as the central bank. And what do I mean by revolt? Well, in doing this policy, they are essentially choking down the short end of the curve and letting the long end of the curve run wild. And when you have that, you have some type of like bond vigilante potentially happen, which is where yields actually go up, even though they're cutting rates. And so that would not be a great environment, right? And again, you don't have to believe what I'm saying. You can just take a look at something like the 10-year US government bond yield, which, ever since they started cutting rates in September of September 17th of 2025, right? When they started cutting rates again, or resuming rate cuts, the 10-year was at 4.028%, and now it's at 4.183%. So rates have actually gone sideways to up since they started cutting rates again. And that's not a great sign, right? And again, this could mean some short term bullish news for some of our risk on assets. But in the medium to long term, you have to be extremely tactical with the way that you position yourself, right? This isn't an environment where you can just buy and hold things forever and just close your eyes. Okay. And I think that the cryptocurrency market experienced that firsthand in 2025, with Bitcoin actually having a down year. It's been having a little bit of a rebound since the new year. And actually, Bitcoin is having a very interesting kind of 4-day rally here ever since the new year. But, in taking a look at the 2025 or 2026 returns on a percent change basis, right? I think it closed at around like negative, I forget, I think it was like -5 or -4% on the year. And so for those people in the cryptocurrency space who just waited around all year just to end up having, a -5% return, you just can't be doing that in this type of environment, especially with this liquidity dynamic that's changing right now. So Who knows? Maybe Bitcoin has a better year this year. It really just depends on what that growth and inflation dynamic starts to signal, which could be changing right now. I still need to see what happens once volume comes back this week. But yeah, that's pretty much what I'm seeing here heading into this week. So yeah, we have ISM manufacturing tomorrow at 10. On Wednesday, we get the private ADP non-farm employment change numbers. And then we also get JOLTS, which is the job openings and labor turnover survey. And then we have non-farm payrolls, which is the government reported jobs numbers, and then the unemployment rate. So this is a pretty big week, right? We get a lot of labor data. And then I believe the week after that, we get inflation data. So these next couple weeks are going to be pretty action packed in terms of the macro data. And so, yeah, welcome back, everyone. Now, when it comes to the dollar, right? So this is another big macro signal, right? When we take a look at the United States dollar, we can see that this has pretty much been in a bearish trend since it broke its bullish trend all the way back in late November, early December. And then right now it's actually having a little bit of an acceleration to the top end of the trading range. Now, what does that mean? We have to first observe which assets are positively or negatively correlated to the dollar. And what my team and I likes to do is we like to take a look at the rolling 30-day correlations versus the dollar, which is what this is right here. I can kind of zoom in. But what you can see right here is that right now gold and precious metals are oppositely correlated to the dollar, meaning that if the dollar continues to rally from here, gold, silver, platinum, all the things that have been going crazy, those will continue to have a correction. But things that are in a positive correlation, like oil, as well as longer term bonds, those will continue to enjoy a strong dollar. Now, what's interesting is that Bitcoin does have a slight positive correlation to the dollar. And so it is interesting seeing how the dollar having a little bit of a spike here, while at the same time, so is Bitcoin. Right. Let's take a look at Bitcoin one more time. And again, even though Bitcoin is still technically in a bearish trend in our model, meaning like if I was to change the color background of my bookshelves for Bitcoin, it would be red. We have to pay attention to see if this starts to change trend here in the next week or so, as well as what that does along with the dollar. So, yeah, dollar correlations, a major thing that we track here, and this is our rolling correlations indicator that we've created, which is accessible for our partnership circle members. But yeah, that's pretty much all I have for us heading into this week. It's really just a wait and watch. And I guess the last thing before I close out here and we go over to our members only portion of the Sunday macro wrap up and we close out the streams is that we had a very large surprise to the upside on the previous GDP numbers that came out a couple weeks ago. And the third quarter first estimate, or the first estimate for the third quarter GDP release was 4.3%. And, you have to remember that the quarterly GDP numbers that come out, that's not the GDP for that specific quarter. It's the GDP for the entire year being updated, right? So it's the annual growth being updated as of the third quarter. And that came in at 4.3%. But then we just had a release on December 23rd for the fourth quarter, and that came down to 3.0%. And when I see that, as well as when I take a look at the deficit spending and seeing how that's a little bit less, right? So the rate of change of deficit spending is slowing down. That is actually a very interesting dynamic and what the market will not like, right? Because this market has heavily been influenced by this large amount of government spending, right? That's what Milton Friedman says, right? If you want to pay attention to where the market is going, pay attention to government spending, right? So yeah, that'll probably be the biggest thing to pay attention to, because if we have a large contraction in deficit spending, then that could be decent headwinds for a lot of the players that have been doing well over the past couple of years. Now, that doesn't mean that we're going to go bearish on the economy or bearish on the market in aggregate. It just means you have to be very specific and tactical on what your portfolio is exposed to, which we'll get into some ideas here after we go offline. But yeah, I'm excited to be back. Had a nice little break, and I hope everyone had a fantastic New Year's. For those who are on the Zoom call, stick around. We're going to go ahead and say bye to the YouTube channels as well as Instagram and TikTok. So I appreciate everyone. Let's have a great week, and I will catch you on the live streams during the week for the daily macro updates.